All right. Hello, everyone, and welcome back to the Weekly Rebalance. We got Ethan back. He's back from Hawaii. How you doing, Ethan?
Hey everybody. Hey Nick. Doing pretty well. I'm still dealing with some jet lag and some sunburn, but overall doing well and happy to be back.
Oh my, sunburn's not fun.
No, I neglected to wear sunscreen the first day, and that was the last day that I made that mistake.
Man, that's rough. That's a rough way to get things started.
It is, but it still was a good week. Good 2 weeks actually. So
Yeah, that's awesome. That's
not
awesome. Well, we
bad.
missed you here. Garrett
Yeah.
filled in. He did a good job. And for those of you who are dying to get some more Garrett, you're in luck because over the next couple of weeks, you'll get some more Garrett exposure. Him and Ethan are going to be doing the weekly rebalance while I'm out for a little bit.
Yeah.
Uh, so don't be concerned for those of you out there.
Yeah, the summer vacations, getting some new mixes in the weekly rebalance.
Yep.
It's funny. I was out for 2 weeks, so Hawaii is 6 hours early, and I don't know how anybody would work in financial services in Hawaii because you missed the entire trading day. And there was one day where I we were out late doing some snorkel, went to bed super late, and I woke up late Hawaii time. I actually slept till 10 a.m. And I woke up, and every morning I'd been waking up. I was waking up at like 4 a.m. before that. And I wake up at 10:10 and I'm like, logging in to
Yeah.
see how the market's doing. And I'm like, the market's closed. I missed the whole day.
That's all right. It
Yep.
kept on going without you.
It did. It did not stop. And that's an interesting couple of weeks.
Yeah.
Lots of activity, especially the end of last week.
Yeah, a whole lot going on. I think we've got a decent amount to dissect here. I don't want to take away too much time from our main topic. We're going to be talking about real assets today for our research of the week, but we do have a little bit to break down here in terms of broader markets recently here. And then on top of that, I think we got to talk about SpaceX a little bit. I know that we've already done that in another episode, but uh, I've been getting a decent amount of calls about it. We've also had a decent amount of changes too, and how the IPO is actually going to go and what our expectations are. So I think we should talk about that a little bit. But
Sounds good. Well, should we first break down last week? Because starting with Wednesday, lots of things going on. With
yeah,
Broadcom's announcement, weaker than expected, guidance from Broadcom on Wednesday, and then the hammer really dropping on Friday with the really strong payrolls and jobs report, which sent yields soaring and the market, especially those chip makers and growth-oriented tech stocks down quite a bit. I think it was the worst day since April of 2025, actually, for the Nasdaq, and not a fun week. And some of that's we recovered a little bit on Monday, and then had some struggles today as well. So lots of volatility coming into play, especially on a lot of those tech stocks.
yeah. A classic example of good news is bad news coming from the labor market. I mean, we had a beat on our last non-farm payrolls report as well for April, more than about doubling the estimate that we had going into it. And then same thing last week. So you get two of those in a row, definitely takes a cut off the table. I think that's pretty safe to say. Now the question is, do we get a hike? And you were talking about seeing that in yields, but definitely felt it in the equity market as well. But kind of funny to think about that when, good labor report, bad for stocks, stocks and bonds.
Exactly. I mean, it makes sense, in a lot of ways, but there's good in that. I guess the economy, some of the economy is strong. That's great to see payrolls. I think it was 172,000 versus the 80,000
Yeah.
expected. So that's great. But inflation continues to be persistently an issue. And we're going to get two inflation numbers this week that I think are going to be very important. CPI tomorrow, and then PPI the day after that, and then the Fed the next week. With that will be Warsh's first official meeting as the chair, and I'm very, very interested to see how Warsh, what his tone is, how things are. I think people are going to be looking for two things from the Fed. What is the difference with Warsh, and then okay, now how do we digest the lingering inflation issue, higher, great payrolls, higher yields? How are we digesting all of this? And what's the Fed going to do? And what's their path forward?
Yep. Yep, big thing to watch there. And like you said, we've got some more inflation prints coming out here soon. The PCE print that we got more recently, I think that was the week before last, was for the most part better than expected. I mean, month over month was a little bit better than estimates. Year over year was about in line. So, PCE a little less volatile than stuff like CPI, like we're going to get this week. So, definitely going to keep an eye on that. But yeah, watching what Warsh does is going to be a big deal for
Yeah,
processing markets going forward.
yeah, definitely. Lots to pay attention to there, in addition to what we've already been paying attention to with the geopolitical risk in Iran and how that's affecting energy prices, and ultimately all goods inflating their prices quite notably. And I think the issue with that is, I mean, hopefully there's a resolution to that soon, and if there is, that will be great. I think we'll see oil, oil prices, energy prices drop, and that will start to, you know, um, help on the inflation front. But a lot of that's still going to linger for a while. So, thinking about the Fed and what they're going to do, they're going to, like you said, and the markets are reflecting this now as well, that most likely we're not going to get cuts, which beginning of this year we were thinking significant cuts. Now potentially a hike. I don't know if that's necessarily the case. It very well may be, and I think that's why we have to pay attention next week when Warsh and the Fed comment on these things, to see what their path is going to be. But things are the macro landscape is definitely changing.
It certainly is. And I mean, on the Iran front, I mean, today we got escalation on that front as well. I mean, we started off the day relatively or very positive, both pretty much across the board. Any major index you looked at was up close to 1.5% at a minimum in the morning, and then started to trail off. And then as soon as we got news about that helicopter being shot down, uh, continued to head down until I think we were peaking. Nasdaq 100 was down somewhere around 3% intraday, and then finished up a little bit from that.
Yeah.
But continuing to get more and more developments on that front, and it's tough to say when the end is going to be. Um, it seems like things are kind of trailing off, and then we get news like that, and so who knows whether that was a rogue agent or something like that. Just certainly not great for the prospects of that ending up sooner rather than later. But
Right. Well, yeah. Hopefully those tensions ease soon, and then that helps on the inflation front. But we will see. And like you mentioned earlier already, Nick, the other big news of the week affecting markets is going to be the IPO of
yeah,
SpaceX. So big. Now, it's interesting about that. So the IPO is on the 12th, right? Um, there's going to be a lot of retail exposure to this, actually,
Mhm.
which is really nice. So you've got investors that are smaller investors that are going to be able to participate, but it's not going to end up in the indexes right away. That's going to take a
No.
couple weeks at least, if that, because most of the index are adjusted for their float. So not, even if SpaceX prices as one of the largest companies in the United States, most of the indexes are adjusted for the actual market cap that's out there, that's tradable shares. So we'll see how that plays out. I was looking at the Nasdaq is probably the first ad that SpaceX goes into, the Nasdaq 100, and so that'll be added to the index probably 2 weeks, maybe 3 weeks after the initial IPO on the 12th. But it might only be about 1% of the index as things as things pan out here. But I mean, a lot of that depends on what the price of the shares are and all that stuff. But it's not going to necessarily all of a sudden be right in your index portfolios right away. But that's going
Yeah.
to start to trickle in to the index portfolio starting maybe 2 weeks after the IPO.
Yeah, I'm certain that they'll work their way in there. relatively quickly for a company that's IPOing. I mean, like you said, the retail access to this has been a lot more than expected. We did that episode a while back talking about ways that you could potentially get access to SpaceX, and we were talking about like, hey, you're probably not going to be able to participate in the IPO because that's just the way these things have gone in the past.
Yeah.
And then over the past week or so, we've just seen more and more custodians lower the minimum account size required to participate in this. And, we've got some people who are interested in participating in just, direct requests that we've received. And it seems like, a retail investor has a decent shot at getting, their order filled on this IPO. Now, how much of it gets filled, that sort of thing, still up in the air. But even on smaller IPOs, like I remember we were trying to participate for one client called in wanting to participate in the IPO of a small insurance company. And they were like, there's no chance that you're going to get any exposure to this. So really interesting to see that with SpaceX, one of the hottest IPOs in a long time, actually getting retail exposure is something that seems possible.
Yeah. Yeah, absolutely.
But yeah, it's going to be a good one to watch. I'm kind of bummed that they set the IPO date for while I'm out.
Yeah, you'll miss it.
That's unfortunate timing.
Yeah, unfortunate timing, but be an interesting day for sure on the 12th. Oh,
Yeah. Yeah.
we'll be following that closely. Have maybe some more news on that next week, depending on
Yep.
how that goes.
Yep. Yeah. And I mean, aside from that, I think the only other thing is just, not necessarily strict value versus growth, but seeing how, I don't know, one of the things we follow the Dividend Aristocrats Index pretty closely here, and over the past couple days, offering a decent amount of outperformance compared to the S&P, whereas we've seen it trail for a little while after the Iran conflict kind of eased up a little bit, and we saw markets move higher. Because I think the Dividend Aristocrats Index, last I checked, was up about 1.5% today. S&P down close to 1%. So
Yeah,
that's been an interesting leadership change, at least over the past couple of days. Again, we don't have a long time period on that. Just kind of a reversal in the sentiment we were seeing with
yeah,
only thing moving higher was chip stocks.
agreed. Very much, yeah, very interesting changes going on right now, or at least the last couple, 3 or 4 trading days.
Yep, definitely. Well, should we get into real assets?
Let's do it. Yeah.
All
I
right.
I'm excited to talk about this.
Yeah, this is a fun one. This is a fun one. We were talking about doing this one last week as kind of a break. It was a bit of a hectic week just for the market in general, just a nice little break from everything
Yeah.
going on. I think everybody's got some sort of interest in real asset exposure and kind of is a fun topic to talk about.
Yeah, exactly. We've had, 2 years now of double-digit equity returns, and it's interesting that these private real assets, these different types of collectibles that are, thought of as maybe niche parts of the portfolio, they're becoming more and more the larger and larger parts of people's portfolios. In fact, there was a study done in 2026 by a Long Angle, and it was a high net worth allocation study, found that the average high net worth investor, I think their median or average investor size in this study was 17 million. And so a $17 million net worth, their average portfolio now runs a 60% stocks, public stocks, 10% fixed income and cash, and 30% privates, alts, collectibles, all those other things, which
Wow.
is very meaningful now, 30% of the portfolio. So for them, that traditional 60/40 portfolio is essentially, that's not the typical allocation anymore. There's a significant allocation to private and alternatives.
Yeah. Well, I mean, it's just become more and more of a mainstream thing. There's a number of services that you can use to track the performance of your real asset, like a stock almost. I mean, a great example is Chrono 24 for all of us watch lovers. I mean, you
Yeah.
can basically build your portfolio of watches if that's something you wanted to track, and you can track the value over time, and they're using real transaction data. So
Hmm.
obviously, it's not as perfect as a stock where everything's identical and all that, but um, there's just an increasing amount of tools that allow you to track these sort of things, and it's becoming more and more part of the culture.
Right.
Through platforms like that and other things like Rally Road, where you can own fractional parts of a dinosaur skeleton or something like that.
Yeah, yeah, exactly. Well, that's the new development here. We can debate this a little bit as well, but platforms like Rally, Masterworks, Public.com, they're bringing. So Rally started. Their famous case was they had a sealed 1985 Super Mario Brothers cartridge. They bought it in 2020 for $140,000 and then had a buyout of $2 million 1 year later. Um,
Mhm.
that type of cars, watches. Masterworks is specifically blue chip contemporary art.
Mhm.
Public.com, wine, farmland, single family rentals, stuff like that. A lot of that's been exclusively for those investors that are high net worth and that have a 15 to $20 million or more net worth. And they do those things on their own. They go buy whatever it is, the collectible, the wine collection, the art on their own, and that's a part of their asset allocation. But now with these platforms coming up, people are able to get exposure to this with much less money, which is very interesting. It's an interesting issue because in some ways I look at that and I think, okay, that's great. We're getting access to smaller investors for different types of asset classes, and that's good. I think the most important thing to discuss there as advisors, or the most likely people listening to this podcast, but even if regular investors or individual investors are listening to this, the big thing that I think that when people ask me about this, it's hard to say that it's bad, right?
Mhm.
But you have to understand it. And most people don't understand what they're getting into. Perfect example, what I think you're going to bring up next, Nick, is the how these items are taxed.
Yeah.
They're not taxed like you would think. They're not taxed like stocks. They're not taxed like bonds. So, but a lot of people getting into these don't exactly know what they're getting into. And the biggest risk is, are they getting into something that has very low practical liquidity?
Yeah.
So even if there's value there, it's not value they can unlock. Most people understand that in their own personal residence, but you can have the same illiquidity or worse in some of these investments over time. And if that's not understood, you can have some very unpleasant outcomes.
Definitely. I think that's a big thing to highlight, especially, with those Rally Road platforms. There's still like a voting system. I haven't actually personally invested any of my own money over there, but from what I understand, there's like a voting system. Hey, we're deciding whether we're going to sell this thing, and then you need a willing counterparty to buy your shares or whatever you're selling. So you still have a degree of illiquidity with that, and I think that's a big thing to highlight. Is the person who's going over to a platform like that, do they fully understand that this isn't something that they could go and sell if they need to pay a bill or something like that? There's a lot of illiquidity that comes with that. Whereas if you were to go out and buy, a classic car and own it yourself, that's a little bit more just explicitly understood that you're taking a bit more of a risk and that you maybe can't turn that into cash right away.
Right.
Uh, that's definitely a big consideration, but the tax piece is huge, and I think a lot of people miss that. And I think it's really interesting because it mainly comes up for the individuals that are able to purchase these assets, that
Right.
it makes sense for them to have a larger allocation to something like this. And that's because, so if you dispose of one of these real assets within a year, that's taxed like short-term gains. That's just like the stock market. No
If you
surprises there.
so if you buy and sell, let's use an example:
Yeah.
watch, art, wine, whiskey, something like
Mhm.
that, some type of collectible.
Yep.
You buy it, you sell it within a year. Let's say you bought it for 100,000, sold it for 200,000. That's going to be subject to your short-term capital gains. Same as
Yep.
short-term capital gains, meaning taxed at your marginal bracket.
Yep. That's 100% correct. So that's always we expect. But usually you're going to hold these things for longer than a year. And that's where this nuance comes up. So if you have a marginal tax bracket that is above 28%, then you will pay 28% in gains on whatever you sell if you held it for longer than a year. So that's much higher than that 15% capital gains rate that we typically see.
Yeah.
So that introduces additional tax drag to an allocation to one of these private assets. And then on top of that, I think there's some interesting nuances. And again, we're not accountants, we're not not the tax experts or anything like that. But there's also some interesting nuances that come up with, let's say you recognize a loss on one of these, paintings that you own or something like that. There's very specific conditions that need to be met for you to be able to actually write off that loss against a gain. Apparently, you need to make it obvious that this was an investment. It needs to be kept at a museum, or you need to have evidence that you've been upkeeping it throughout that time. It can't be like, oh, I just kind of bought this thing and now I'm selling it. So it's a tricky tax world, and it's a lot to keep track of as well. I mean, probably a little bit difficult for your standard individual using TurboTax filing their own returns to keep track of something like a large baseball card collection or something like that.
Yeah, exactly. Well, and that is most, and like you said, most people that are considering making a direct investment in these things, like a art collection or a collectible car or something like that, they're in that higher tax bracket, 28% or more. And yeah, so it's Internal Revenue Code section 408M. Gains on long-term holdings of collectibles are taxed at the maximum federal rate of 28%. So yeah, normally you're in the either 0, 15%, or 20%, if you're in the highest bracket.
Yeah.
But most of these high net worth clients that are getting access to this are in those top brackets, and yeah, they can be quite extensive, because you also have, if you're a high net worth client, you could be subject to the 3.8% net investment income tax. And so add that to the 28%, you're at 31.8% for something like that. And then, state taxes on top of that.
Yeah.
So very, very high tax burden. Now, a lot of the 28% bracket, you're making decent money at 28%, right? But if you did something like Rally Road, Masterworks, etc., and let's say you didn't go for the whole art collection, but you bought a share in it, you're still subject to that. If you're making good money, you're in that higher bracket, you could actually have a pretty significant tax drag associated with that purchase. But most people don't know that.
Yeah. No, it's huge. I mean, I think that's an interesting thing too. So Masterworks, they're specifically on the art side. Rally Road, they're a little bit more generic. You can do dinosaur bones, crazy stuff like that.
Mm-hmm.
It seems to me, at least this is just my perception of it, the classic car collecting, that's always been a thing, but it hasn't really been seen as an investment until more recently. I feel like that's a more modern thing. Similar with all the collectible stuff, video games. I mean, that's obviously newer, but just memorabilia. Baseball cards have really become more and more of a thing. I know that they've always been collectible, but it seems like they're becoming more and more of a. People see them as more of a legitimate asset class. Whereas art has always kind of been one of those things that the very wealthy have been interested in and investing in and diversifying their portfolio with it. So, I don't know. I just interesting to see the space get broader and broader over time. And it seems like everything is collectible these days too. There's always, it's kind of funny. I think there's certainly more and more people just investing in different assets and kinds, kind of expecting a return. But that's another interesting trend we've seen in this space as well.
Right. Well, yeah, exactly. Well, we've kind of put a negative spin on this
Yeah.
unintentionally, right?
Yeah.
Because there are obvious bull cases for this as well. I mean,
Yeah. No.
perfect example is, you know, during periods during periods of major market sell-offs, a lot of these collectibles just they hold their value.
Yeah.
And there's a reason why these high net worth investors are doing this, have been doing this. And yeah, they have it's a great way to diversify. There's very low correlation to public equities and fixed income with these collectibles. I mean, it's I mean almost zero, which is
Yeah.
a big positive. There's also, a positive inflation hedge. You're talking about scarce assets, so they're typically going to outpace inflation. Um, so there's benefits there. We talked about some of the tax inefficiencies, but there's efficiencies in that you have a step up on basis from one generation to the next.
Yeah.
But it's again, if it's understood, they can and used properly, it can be a very nice allocation for the right client for those
Yeah.
reasons. But again, a lot are not understood, which is the risk.
Yeah. I 100% agree. I definitely, it's one of those things that comes up and it's easy to get kind of a negative spin on it, or, it seemed like we're really beating down on this, but it is an interesting allocation and it has its valid place. Like you said, I mean, very low correlation to traditional equity markets, fixed income markets, but also decent returns. So this is the Haggerty Blue Chip Index, and this basically tracks a basket of cars, post-war cars, and their price performance over time versus the S&P 500. So we've got the S&P 500 in gold here, and then the Blue Chip Index in blue. And while the reason of this article is, the Blue Chip Index outpaced the S&P 500 for a good long while, and then now it's trading off and you're better off being in the S&P 500. And while that's true, looking at these total return numbers, um, one of the things that this doesn't highlight is what about combining these two assets together? Combining uncorrelated return streams and strong returning return streams increases the risk adjusted value of the portfolio. That's just classic portfolio theory. So especially in that context and tying it together with, a high net worth investor, they've got a meaningful portion of their portfolio exposed to something like this and the S&P 500. Combining those two things together is a positive thing for their portfolio.
Yes, exactly. Well, and look at that chart. Look at the times in which the S&P was doing poorly and the times in which the S&P was doing well,
Yeah.
and compare that to that blue chip index. Perfect example, 2007 through 2010 there.
Yep.
I mean, the S&P is tanking obviously during that time for, all of us know that, right during the great financial crisis. But that index of collectible cars doing great, actually positive during that period of time. So, and positive pretty significantly.
Yeah.
That is a notable lack of correlation. And like you said, Nick, combining those two together, which is what we're talking about doing here. So I think the percentage, if you were to use that study, we're talking about 25% of net worth invested in these type of things. And that's a meaningful amount to combine with public equities, and it's a meaningful amount that is not correlated to public equities, which is one of the biggest reasons to do so.
Yep. Yeah, I 100% agree. It's easy to get down on it, but there's a valid case for this. And I think, especially with the adoption that we've seen over the past few years, this is something that's here to stay. And, you know, especially not incorporating these assets into a high net worth investor's portfolio and the discussion about their portfolio, I think that's a big disservice. Uh, usually those wealthier investors, they have some sort of hobby. They've got a car that they really love. They've got some sort of a collection uh, that they've just amassed from being interested in it. And it's easy to kind of ignore that as just being like a hobby, even though that may have a meaningful amount of value. And tracking that may be very important and add additional color to their portfolio.
Yeah, absolutely. Well, and a lot of those investors, they have a passion for these things, and they actually tend to do very well in making the choices in which they invest in that art collection or that watch collection or, car collection, whatever it might be, because they have a passion for it. So it helps to be
Yeah.
able to speak to that and not just dismiss it as a big mistake, because in a lot of cases it is not. And like we talked about, it provides a meaningful amount of diversification. The risk would be just, and this is the risk for small and large investors, is are you taking too much of that and putting all of your eggs in one basket, or are you actually getting the diversification benefits? And where does that stop? Where does it become too much of your portfolio, and now you're going the opposite direction and getting too concentrated, especially in something that's illiquid? It's not such a big risk to be concentrated in a stock portfolio that's diversified, right? But if you're concentrated in an illiquid asset class, especially because a lot of these illiquid asset class tend to be larger, like they're chunks, right?
Yeah.
If you have a car, if you're worth $17 million in this case study, for example, and you're going to put 25% of your net worth in collectibles, and you go out and buy $1 million car, you've got concentration risk from the fact that this purchase that you made is a very large purchase. So you can technically be getting lack of diversification and whatnot, but you might have concentration risk within that asset class, which can be dangerous. Which again is a case for, hey, some of these platforms, again, for smaller investors, gives you the opportunity to diversify and still participate in that market without having, as many dollars locked up in it. Because you can accidentally, even for a high net worth investor, when you're talking about going and buying a blue chip collectible car, you're talking hundreds of thousands of dollars, if not in the millions of dollars, and that's a meaningful chunk. Even for a client that has 15 to $20 million.
Yeah. Well, I think this brings up a couple things. So I think this is an interesting topic. And like I said, or like you mentioned, we started off this conversation, it was a little bit more negative. And I think that's because there's some just automatic hesitation from this space because it's easy to go off the rails with this. Usually it's a personal interest that somebody has and they're really interested in the space and they want to go out and purchase these assets and they also want to use them as an investment. And I think while that's definitely something that someone can do, there are some dangers with that. And potentially those dangers are you get, attached to it, you're not actually willing to sell it, things like that, kind of blurring those lines. It's easy to happen with something like this. So um, that's one of the big dangers that comes up with something like this, kind of getting clouded, your judgment clouded by, oh, I'm going to really enjoy this, and it's an investment, but maybe not fully committing to the idea that, oh, I might need to sell this or something like that.
Yeah.
That's easy to do. What do you think though? So I think there's a strong case for adding assets like these to a client portfolio, but I don't think I've ever sat in on an advisor meeting where we've recommended that somebody go and buy a Ferrari, like no matter how rich they are.
Yeah.
What do you think?
No.
Do you think we should be doing that?
I know I don't I don't know. I have never sat in a meeting and recommended that either. Um, but yeah, at least I think it's fair to have that as part of the discussion. And I think if you really do have clients that are in that realm that have a, 50, 100 million plus, at least being able to talk about it is meaningful. Being able to help them with what's a wise allocation, what's becoming too much. Because we're not supposed to be experts in what painting, what car, what watch, what collectible item is going to appreciate or depreciate. And there are specialists for that. We're not supposed to be specialists in that, even if some of us like those hobbies. But being able to have a meaningful discussion about what is an appropriate size of an investment like that versus what is not for their overall financial plan is probably the most meaningful thing to do.
Yeah. Yeah, for sure. I think a lot of this exposure almost becomes, especially when we're talking about like true real asset in the sense of like cars, stuff like that. It's almost coincidental. It's like, oh, I have this interest. I've kind of purchased these things. I've built up quite the collection. It's becoming large enough. I need to start tracking it, that sort of thing.
Right.
As opposed to like an intentional allocation where like, no, I need to get my classic car allocation up to 20% of my portfolio.
Right.
And I'm going to
It's
do
not
whatever I
exactly
need to
how it
get it up
works.
there. Yeah, not really how that works. It's just, these wealthier people tend to have hobbies that are expensive.
Yeah, exactly.
But yeah, well, I mean, we talked about the low correlation, pretty decent returns. Um, what do you think? I guess the final thing that we haven't covered is tokenization seems to be coming for this market.
Yeah.
What do you think about that?
I think, yeah, it goes along with these platforms, making things easier to get access to split up and associate the value with more than one investor. Um, I mean, like I said, I think some of that is good. It brings opportunity to others. The negative and the downside is how many people are getting exposure to things that they don't understand.
Yeah.
And they're taking outsized positions in something that they shouldn't be taking an outsized position in. Um, so again, positives and negatives of that. What do you think, Nick?
Yeah, I tend to agree. And I mean, the other thing too to keep an eye on with this space is as it becomes more and more mainstream, as more people are able to access it with these, partial ownership platforms, how much does the correlation increase? I don't think that that's something that shifts drastically and we go to one or anything like that. I just think as you make it more and more mainstream, as it becomes more and more like the stock market, it's just inherent that the behavior is going to change slightly. So introducing something like tokenization that further pushes us down that road where it's easier and easier to transact in smaller quantities, I just think it's a potential that we see correlation increase. That's the
Yeah,
only thing at the top of my mind. We've kind of seen that with other things. So,
yeah, exactly.
but
Well, time will tell.
yeah, overall fun space to cover. And
Yeah.
maybe one of these days we'll tell somebody to go buy an F40. I think that would be a really fun conversation.
Maybe.
Can I drive it on the weekends?
Yeah.
I
If you
recommend that you
I'll
buy
keep it for you.
it. I recommend that you buy it, but that I hold on to it for you.
Just for safekeeping, just like, custody.
Yeah, I promise to fill it up.
Yeah.
Well,
Well, I've got one question for you if you want to move on to the trivia. I've got one
all right,
decent
sounds good.
question.
I've got one for you too.
All right, cool. You want me to go first?
Sure, go for it.
All right. So the Knight Frank Luxury Investment Index tracks 10 categories of collectibles. Over the trailing 10 years, ending in 2024, the index was up 72.6%. Two specific categories outperformed. Can you name them both?
Outperform the average
Yeah,
for
they
that.
were the top
Okay,
two performing categories of
I'm gonna
collectibles.
say wine and cars.
Ooh, close. Cars, I believe did well in there as well, but the top two were fine wine and luxury watches.
Okay, all right.
Mhm.
Wow.
Yep.
I know that wine has gone absolutely crazy. That's a market I know nothing about. I just know that the returns have been really impressive for,
Yeah.
expensive wine and that the correlation is low. I've seen a number of articles about that.
Yeah, I know nothing about that as well, but I know exactly what you're talking about. I've heard about it, just I know nothing. I have no way of analyzing that or discussing it very well at all.
No, that means absolutely nothing to me. But yeah, wow. 72% over 10 years.
Yeah,
Okay. Yeah. I wonder what was dragging it down but that
yeah.
that's interesting. All right. I've got one for you.
All right.
If I were to ask this to Garrett, I would have to be very specific. He would need to give me the model and like the specification and everything like that. But I'll take like a little bit more of a broad
Okay.
answer. Okay. The most expensive car ever sold at auction fetched $143 million in 2022, nearly $100 million more than the previous record. It wasn't a Ferrari. What was it, and how many were made? Don't answer that. How many were made? Question. That's a wild thing to ask.
I was gonna guess the Ferrari 250 GTO, but
I
I guess it's
know.
not. Okay. It
Yeah,
wasn't a Ferrari.
it was not a Ferrari.
And
I
how
would
much did
take
it sell for? What?
143 million. What about just the manufacturer? Because I would never get the
You would never guess this.
specific model.
It wasn't like a early Bugatti, was it?
No, no, not an early Bugatti.
What was it? I don't know.
Yeah, it was a Mercedes-Benz. So it was a 1955 Mercedes-Benz 300 SLR Uhlenhut coupe.
Wow.
Only two were made. It looks like the Gullwing Mercedes,
Gotcha.
but it's a little bit more aggressive. It's got pipes that come out the side. It's pretty cool. Is it $143 million cool? I don't know, but it's
So it's
pretty.
I want to see a picture of this. So it's a Mercedes
Yeah.
SL.
Oh yeah, 300 SLR Uhlenhaut, which is Uhlenhaut.
Was it like all original?
I would guess so for that price. I would hope so.
Wow. I did not know that.
Yeah, I didn't either.
That is certainly a blue chip collectible.
Yeah, no doubt, no doubt. That's a
Crazy.
meaningful allocation for whoever owns that.
Yeah, you would think so. Who bought it?
I have no idea. No idea.
Let's see who, if I can. But it was probably like not public data. It wasn't a public auction. Oh yeah, it was
Hmm.
held by RM Sotheby's at the Mercedes-Benz Museum. Did Mercedes sell it themselves?
I don't know. I should have done more research on it since this was my trivia question.
Interesting. It was a private affair organized by Mercedes, anonymous seller. Wow. And 10 collectors were selected
Oh,
as bidders.
okay. I see how it is. That probably
Uh,
does drive up the price. If I get selected by Mercedes to bid on something, I gotta show 'em my best shot.
yeah. Wow. That's cool.
It is a neat car.
That's a very neat car. Yeah. Well, good question. Good question, Nick. I did not know that.
Yeah, that was a fun one. Well, I think that does it for this week.
Sounds good. We'll wrap it up. We'll be back next week. We'll miss Nick. Garrett will be back and we will we'll have him back in a couple weeks. I think what you'll be out for 2 weeks, Nick?
Yep, 2 weeks.
All right, sounds good. Well, have a good trip, Nick, and we'll talk to everybody next week.
All right. Thanks, everyone.